Buying a house with no savings isn't easy, but I've helped a lot of people pull it off, and I know exactly what works. Now, I've got to warn you, this path is risky. If something breaks, you've got no cushion. If the wrong expenses pop up, you could be stuck. And if you're not careful, you could end up house poor the day you move in. Most people will tell you it's impossible, and I know how discouraging that can feel. But it's not impossible if you follow the right roadmap. And in this video, I'm going to walk you through the exact steps I've used with my clients. There's also one upfront cost almost every first-time buyer forgets, and if you miss it, it could wreck your budget before you even get the keys. I'll share that with you in just a few minutes. The very first thing you want to do is see if you qualify for a USDA loan. This is one of the only true zero-down programs out there, and it also has lower mortgage insurance compared to FHA, which keeps your payment down. And here's why it's such a big deal. If you structure the offer right, USDA is one of the only loans where you can actually get into a home without spending a single dollar out of pocket. No down payment, no out-of-pocket closing costs. But USDA isn't the only option. FHA usually requires 3.5% down, and conventional loans can go as low as 3%. There are even a few rare zero-down conventional programs out there. There's also VA loans, which are for veterans, and they're also zero down. The key is, a lot of times you can pair your loan with down payment assistance, and that can bring your out-of-pocket costs down to almost nothing. I'll talk more about how those programs work a little later. Now let's talk about that tip I promised in the beginning of the video. No matter which loan you use, there's a cost most buyers completely forget about, and it's due before you even get the keys. Even with a zero down loan, you still need to pay for your home inspection and your appraisal. The inspection usually runs around $400 to $600 on the low end, and that money has to be paid out of pocket right after your offer is accepted. You can't roll it into the loan. Most lenders also require an appraisal. Sometimes that fee can be wrapped up into your loan, but a lot of the time you'll need to cover it up front. And then you've got prepaid expenses like homeowner's insurance. Some lenders will let you roll those into the loan, but not always. And here's another cost a lot of people forget about: the earnest money deposit. That's the money you put down when you make an offer to show the seller you're serious. In most markets, that's usually 1 to 3% of the purchase price. That money goes toward your down payment or closing costs when you close. But the catch is, you need to have it ready up front when you make the offer. If you're buying with little or no savings, you've got to plan for this, and it could stop your deal before it even starts. Now, people will sometimes ask me, if the seller covers my closing costs or I get down payment assistance, do I ever get that deposit back? Here's how it works. The earnest money isn't an extra fee. It's just a deposit that sits in escrow. At closing, it gets applied toward your down payment or closing costs. But if all those costs are already covered, then yes, you'll actually get your deposit refunded to you. Either way, you need to have it up front to get under contract. These aren't huge numbers compared to a down payment, but if you don't plan for them, they can wreck your budget before you even close. Even if you get through these upfront costs, there's a bigger risk you need to know about, and it's one of the main reasons I don't usually recommend buying with no money saved. I'll explain what that is in just a few minutes. Now here's the good news. With loan programs, you can ask the seller to cover your closing costs for you. With FHA and USDA, the seller can contribute up to 6% of the purchase price. With conventional loans, it's usually capped at 3% if you're putting less than 10% down. Either way, it can make a huge difference. So let's say you're buying a $250,000 home. If the seller agrees to cover even $7,000 in closing costs, that could cover all of your closing costs that you need to bring to the closing table. Now, does this work in every market? Not always. If a house has multiple offers, the seller isn't likely to agree. But in some areas, homes are staying on the market longer and more price cuts are happening. So sellers are more open to covering closing costs than they were just a couple of years ago. Here's an example of how it could play out. I'd look for homes that have been on the market for a few weeks or a few months, maybe ones that need light cosmetic updates. I'd come in with a full price offer, but instead of asking for a discount, I'd ask the seller to cover closing costs. It's a psychological thing. Sellers often feel better giving credits toward closing costs than lowering the sale price, even though the math works out the same. Something else to consider is if the home appraises for more than the purchase price, some loan programs like USDA will actually let you roll part of your costs into the loan up to the appraised value. That's not something I'd count on, but if it happens, it's a nice bonus. Earlier I mentioned down payment assistance, so let's talk about that for a minute. If you don't qualify for USDA or can't get enough help from the seller, this is usually the next best option. Most people think FHA means you have to bring 3.5% down, or conventional means at least 3%. But with down payment assistance, you can get that covered for you, and in some cases even part or all of your closing costs too. Now these programs come in different forms. Some are true grants you never have to pay back, some are second loans that you repay when you sell or refinance, and some are second mortgages with their own monthly payment. There are thousands of these programs across the country. City, county, and state housing agencies all run them, and sometimes even lenders offer their own. The key here is to find out what's available in your area. A good place to start is downpaymentresource.com, or just Google your state or county housing agency. They'll have the list of programs you can apply for. But here's the catch, and this is where I want you to be careful. In some markets, using down payment assistance can actually make your offer weaker. Sellers sometimes see down payment assistance loans as more complicated because you have to get approved for the main loan and the assistance program, and if one of those falls through, the whole deal can fall apart. That doesn't mean it's a bad option, it just means you want to work with a lender who knows these programs inside and out. They'll help you compare terms and figure out whether it's the right move in your situation. Now this next one won't apply to everyone, but if you have a parent, sibling, or even a close friend who is willing to help, you can accept gift funds. Most loan programs allow gift money to be used for down payment or closing costs, as long as it's a true gift. Even a few $1,000s could be the piece that makes everything come together. And I'll be honest, asking for help isn't always comfortable, but if it's the difference between getting into a home or waiting another 2 or 3 years while rent keeps going up, I'd at least have the conversation. Now, if I were buying with no money saved, I'd also keep my expectations realistic. I wouldn't be shopping for my dream home. I'd be looking for something clean, safe, and move-in ready, a starter home that works for my budget. I'd focus on homes that are a little dated but well-maintained. Homes that have been sitting on the market for a few weeks or a few months, where the seller might be more open to concessions. What I'd avoid are fixer-uppers, not because they're bad investments, but because if you don't have savings, one surprise repair could wreck you financially. Now, if you can't get the seller to cover your closing costs and the home didn't appraise high enough to roll them into the loan, the next thing you want to do is ask about lender credits. Here's how that works. The lender agrees to cover part or all of your closing costs, but in exchange, they bump up your interest rate slightly. So maybe your base rate is 6.5%, but with a lender credit, they raise it to 6.75% and use that extra interest to give you $4,000 or $5,000 toward your closing costs. Now, is that the best long-term move? No. You'll pay more in interest over the life of the loan. But if the choice is between closing on the house or having the deal fall apart because you don't have the cash, it's worth considering. And if rates drop later or your credit improves, you can always refinance. Just remember, refinancing isn't free. It comes with its own costs. Now let's talk about what happens after you close, because this is the part that most people overlook. Buying with no money saved is possible, but it's risky. If I were doing this, I'd ask myself some honest questions. Do I have a stable job? If something breaks, do I have a credit card or family member I could lean on temporarily? How quickly can I start building up reserves? Because the truth is, once you close, the house is yours. If the water heater dies or the roof leaks, it's not your lender's problem, it's yours. That's why if I bought with zero savings, I'd make it my top priority to build a safety net as soon as I moved in. I'd aim to save at least $2,000 to $3,000 as quickly as I could, just enough to cover small repairs or emergencies. I'd also consider a home warranty. They're not perfect and they don't cover everything, but for a few $100 a year, they can buy you some peace of mind in that first year. Sometimes you can even negotiate to have the seller or your agent cover the first year of a warranty. Now back to something I mentioned earlier. Here's the real risk I need you to know about this strategy. When you buy with nothing down, you're starting with almost no equity. That means if you had to sell right away, you might not make any money, or worse, you could owe more than the house is worth. On top of that, with FHA or USDA, you've got mortgage insurance built into your payment until you refinance or pay off the home. In a perfect world, I tell everyone to put 20% down, avoid mortgage insurance, and have a full emergency fund. But the reality is not everyone can wait years to save that up. So the key is knowing the trade-offs before you jump in. So if I had no money saved and wanted to buy a home, this is what I do. First, I check if I qualify for USDA, and if not, I'd look at FHA or conventional paired with down payment assistance. I'd plan for those hidden costs like inspection and appraisal. I'd ask the seller to cover my closing costs, and if that didn't work, I'd look at lender credits as a backup. I'd accept gift funds if someone was willing to help. And most importantly, I'd keep my expectations realistic and start building a safety net the second I move in. Buying with no savings isn't the ideal way to do it, but it can be done if you understand the trade-offs and have a clear plan for what comes next. If you're looking for a realtor in your area, I can help you with that. There's more information on my website, workwithdang.com. Please like and comment if this video helped you out, and I make videos like this every week, so if you haven't subscribed yet, please do.